Hi everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. So you don't have to. Today we tackle Mangoceuticals and its latest filing. Buckle up because it's got some interesting twists and turns. This report from Mangoceuticals is all about some serious business deals they've been making, especially with their CEO and chairman Jacob D. Cohen via something called the Tiger Cub Trust. Sounds like something out of a spy novel, right? But really it's just a way the company is getting crucial funding. So here's the main story. Mangoceuticals has this convertible note, a kind of loan that can turn into company stock, and they've reworked this deal with Tiger Cub. They also threw in some warrants, which are basically options to buy stock in the future. These are big moves that could really change how the company works and who owns it. Let's break down this amended and restated convertible promissory note, or A&R note as they call it. Basically, the company owes Tiger Cub money, but now the terms are different. The most interesting part is that Tiger Cub can now swap this debt for company shares and the price. It's tied to the stock market price at the time, but with some specific calculations to make sure it's fair and avoid certain approval issues for the company shares and the price. It's tied to the stock market price at the time, but with some specific calculations to make sure it's fair and avoid certain approval issues for the company. This agreement to amend is pretty important because it's the document that makes all these changes official. It's like a handshake deal that's been put on paper to update the original loan. This also granted Tiger Cub those warrants we talked about, giving them the right to buy a specific number of company shares at a set price, which is $1.8 for $15 per share for a good chunk of time. Now, these aren't just any warrants, they're specifically for 50,000 shares of Mangoceuticals common stock. They expire in July of 2028, and importantly, they can only be bought with cash. This means Tiger Cub is putting more money in to get these shares if they decide to exercise them. Plus, the company also sold its own shares in a deal that's a bit unique. This bit here is fascinating. Mangoceuticals sold over 26,000 shares to a company called Platinum Point Capital under an equity purchase agreement, or ELOC, for about 1 point theft agala $1.56 per share. This is part of a larger agreement where Platinum Point Capital agreed to buy up to $25 million worth of Mangoceuticals stock. Essentially, the company is selling its stock to this investor to raise cash, but the selling price is determined by what Platinum Point Capital can later resell those shares for, which is a clever way to get funding tied to market value, but with a discount. This detail about the purchase price is key. They get 90% of what the investor gets when reselling the shares over a few days after the company alerts them. This means Mangoceuticals is selling its stock at a discount to its future market price, which is pretty common for companies needing quick cash, but it also shows they're willing to give up some potential upside for immediate funds. The company is also using specific exemptions from registering these stock sales. They're saying these shares are not being sold to the general public, but to a select group of investors, often called accredited investors, who are considered sophisticated enough to understand the risks. This is a standard practice to speed up fundraising and avoid the lengthy process of public registration. Now let's look at the Tiger Cub warrants again. These warrants allow the holder to buy shares at a specific price, $1.8115 per share, and they are valid until July 2028. This gives Tiger Cub a clear path to potentially increase their ownership in Mangoceuticals if they believe the stock price will go up. If Tiger Cub decides to use all of its warrants, it could mean up to 5,000 new shares of Mangoceuticals stock enter the market. This could dilute existing shareholders, meaning each share represents a smaller piece of the company, but it also means more capital for Mangoceuticals. And if the big loan, the A&R note, gets converted, it could also lead to more shares being issued. If the full $100,000 loan plus an estimated $18,000 in interest is converted into stock at the $1.785 per share price, that could add another roughly 6,000 shares to the total. So between the warrants and the note conversion, we're looking at potentially over 11,600 new shares. Adding to the dilution picture, another investor, Indigo Capital LP, used its own convertible note of $500,000 plus $90,000 in interest to buy shares. This amounted to almost 4,000 shares at a conversion price of $1.50 shares, at a conversion price of $1.555 to use, being turned into equity, diluting ownership for existing shareholders. The company's common stock traded on the Nasdaq Capital Market is the main vehicle for these transactions. This is where you'll find the company's shares trading and where the impact of these new shares will be felt by investors. Mangoceuticals identifies itself as an emerging growth company. This means it has fewer reporting requirements and can take advantage of certain regulatory flexibilities, especially regarding accounting standards. It's a common designation for younger companies still growing. So what does all this mean for Mangoceuticals? For starters, the company is actively raising capital through debt and equity, both directly and by allowing debt to convert into stock. This shows a clear need for cash to fuel its operations or growth. It also means a significant amount of potential stock dilution as these convertible notes and warrants are exercised or converted. This can put pressure on the stock price for existing shareholders as their ownership stake gets smaller. The reliance on specific investors like Tiger Cub Trust and Platinum Point Capital suggests the company hasn't yet accessed broader, more public funding markets on a large scale. The valuation of their common stock at conversion points like $1.15 or 1.785 per share compared to the selling price of 1.564458105445 in the ELOC deal shows they're willing to offer discounts to secure funds, the warrants. With an exercise price of 1.28 when 15 also suggests they expect their stock to perform well in the future to make these options valuable. A key risk here is the potential for heavy dilution if all these convertible instruments are exercised or converted. This could significantly impact earnings per share and the stock price. The company's strategy seems to be focused on securing funding through these structured deals, which is common but carries inherent risks. The fact they're an emerging growth company also means they're still finding their footing, and these financial maneuvers are likely part of that growth process. In conclusion, Mangoceuticals is in a phase of aggressive fundraising and financial restructuring. The deals with Tiger Cub and Platinum Point Capital are essential for its operations, but they come with the significant consequence of potential stock dilution. Investors should be mindful of this dilution and whether the company's growth prospects justify the increased share count. The company's direction seems geared towards operational expansion funded by these convertible instruments, but investors need to watch closely to see if the actual business performance can support these financial moves. Alright, that's our deep dive into Mangoceuticals' latest filing. What are your thoughts on these funding strategies and the potential for dilution? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate decoding to follow. And don't forget to join our Discord community, linked in the description for continued discussion and insights. Thanks for tuning in, and see you next time.